Hello and welcome, everyone. My name is James Thornton, and I'm the Deputy Head of Marketing at LSE Executive Education. Thank you very much for joining us for today's webinar, Decoding Financial Statements and Elevating Equity Valuations Through Earnings Quality Analysis. We have two fantastic presenters covering this topic today, Dr. Stefano Cascino, Associate Professor of Accounting at LSE, and Dr. Maria Correa, also Associate Professor of Accounting at LSE. Both teach on our new on-campus executive education program, Financial Statement Analysis and Equity Valuation, running from the 19th to the 23rd of February in 2024. We're going to post more details about this program in the chat for you to check out. In a moment, I'll hand over to Stefano to start proceedings, but please note that there's going to be a recording of the webinar that we'll be sharing with all attendees in due course. Hopefully that should go out tomorrow. And in addition, we're going to be having a Q&A at the end of the webinar for you to ask questions to Stefano and Maria. So please submit any that you may have about the presentation, the topic, or the program. You can put that into the chat and we'll take a look at that and answer that in that session. I'm now going to pass over to Stefano and to take you through today's presentation.
Thank you very much, James, and thank you very much, everyone, for tuning in to this webinar. We're going to offer a taster session in which we are going to leverage on the importance of earnings quality analysis to elevate equity valuations. Just to give you an overview of the agenda of this presentation, I'm going to discuss the concepts of fundamental analysis, the basic philosophy of this executive education program. Then I'll dive into the concept of earnings quality, and then Maria will take over and she will be discussing earnings management and how to detect earnings manipulations and the necessary accounting adjustments that investors need to make in order to come up to a sensible valuation. And then we will conclude with a Q&A session. Now, financial statement analysis and equity valuation, our executive education program, takes a fundamental analysis perspective on equity investment. What this means is that we will take a fundamental analysis view, which is focused on the process through which an investor or an equity analyst identifies the value generated by a company, which is often referred to as the intrinsic value. Now, the basic goal of fundamental analysis is to forecast the value that a firm is able to add to its operations that is currently not recognized on financial statements, and financial statements being the primary source of information about the profitability of the firm. Now, this ultimate goal of fundamental analysis is basically the one of yielding returns to investors, excess returns to investors, by allowing them to identify spot securities that are currently mispriced. So they could be, for example, overvalued or undervalued with respect to their intrinsic values. Now, to give you an idea, though, of this concept of intrinsic value or fundamental value, you don't need to think about it as a point estimate. Rather, this is more of a range, right? A range of plausible values with the minimum and the maximum. So basically a confidence interval around this estimate of intrinsic value of a stock. And the fundamental analyst perspective is the one in which you would actually buy the stock whenever the stock price falls below the lower bound of the intrinsic value estimate confidence interval. Now, obviously, there is a framework, a theoretical framework in which we need to operate, and we know that in theory, if the efficient capital markets hypothesis were to hold, securities would basically be always correctly priced, which means that in any given point in time, the price of a stock will reflect all available information. And if this were to be true, well, basically price will be equal to value, and there would be no room for fundamental analysis. Now, the danger with this investment style, though, is that price is what you pay, but ultimately value is what you get. And in fact, with the fundamental analysis perspective, we're going to challenge market prices. So our philosophy is more of an active value investing strategy in which current market prices could be too high or too low, and so fundamental analysis should guide the search for intrinsic values and mispriced securities with the ultimate goal of earning abnormal returns for our investors. Now, what is the evidence of market efficiency? How does it stack up against the reality? So we do know, and we have evidence of pockets of inefficiencies where market prices might temporarily deviate from fundamentals. However, though, in practice, it's not easy to come up with trading strategies that will yield an abnormal return for investors. And so these trading strategies are definitely not risk-free, are not arbitrages. And so it is important to kind of learn state-of-the-art fundamental analysis techniques. And this is our aim within this executive education program. And ultimately, this should be key to help investors, analysts, or simply managers try to understand which securities are currently mispriced and how this could ultimately unlock value. Now, this is a graph that I really like because it gives us an idea of how markets can be inefficient. In this graph, I'm basically plotting two things: the price and the net asset value for a closed-end fund. This closed-end fund goes by the ticker symbol of Cuba, CUBA. Now, this has nothing to do with the Caribbean island. Nevertheless, what you can see here is that up until November 2014, the Cuba fund had a price that was 10% below the net asset value, which is normal for a closed-end fund, which is traded at a discount. Then all of a sudden, there is a 70% jump. So the price of the fund shoots up on December 18, 2014. Which coincides with the former president of the US, Barack Obama, making an announcement of basically lifting embargo restriction on the island of Cuba. And now you see, the fund has nothing to do with the Cuba island. Nevertheless, information gets impounded into capital market erroneously. And so there is a huge deviation, a huge inefficiency. Now you might think this is temporary. But if you look at the persistence of this inefficiency, it almost lasts for 1 year. Now, a fundamental analyst would have understood this price deviation from fundamentals, right? And could have set up a trading strategy to take advantage of it. So does it pay off to engage in fundamental analysis and so basically value investing in equity markets? Well, according to someone that has been extremely skillful and successful in fundamental analysis and value investing, the answer is yes. And I'd like to point out that Warren Buffett believes that understanding accounting is unbelievably important, especially its nuances, because accounting is not perfect. But knowledge of accounting is essential if you want to invest in stocks or if you want to basically understand the nature of a business. Now, how does Mr. Buffett stack up in terms of performance historically compared to the universe of mutual funds? Here you can see basically Warren Buffett's alpha, and this is the distribution of the information ratios of all mutual funds in the US over the last 40 years. And you can see that Warren Buffett has done extremely well. So basically, this is to motivate us that fundamental analysis and value investing are valuable. And so understanding fundamental analysis and its drivers can really add value to your understanding of stock valuation and security prices. Now we know that in terms of valuation, common approaches are intrinsic valuation, such as DCF, and relative valuation approaches based on price multiples. But irrespective of the approach, the importance of fundamental analysis is that it allows us to isolate the core recurrent profitability of the firm, the extent to which a firm is exposed to risk, and to kind of tease out the growth prospect, to what extent the business is going to grow in the future. And of course, we gather all this information from financial statements because from core earnings will be able to discern what this will mean in terms of free cash flow formation, what this will mean in terms of estimation of a cost of capital, but this would also allow us to select the appropriate fundamentals for price multiples, such as EBITDA and earnings as denominators of the respective multiples. And now let's start diving deeper into this concept of earnings quality, why it is important, why it matters. Before we do that, let's, with a very simple example, understand the relative importance of cash accounting and accrual accounting. We all know that reported earnings that we find in financial statements ultimately are the sum of cash flows and accruals. And we know that cash is king because it's hard, verifiable information based on past events, whereas accruals are the result of estimations, right? It's managerial discretion. Think about the depreciation of an asset or the way in which receivables are estimated or provisions are estimated. And these tend to be forward-looking, because if you think about depreciation, a depreciation of an asset basically is telling us what's the useful life of that asset and what's the current usage of that asset during its useful life. Now, one could wonder, why do some investors in financial markets just focus on cash flows and seem to disregard accruals? And are accruals and earnings at all important? Yes, they are, and I will demonstrate it to you with a very simple example. Imagine we have two hypothetical firms. One is very simple, as a steady stream of $70 of cash flows over a 5-year horizon. And therefore, let's assume that the only performance metric that we're going to use to track this firm is total cash flow, which at the end of year T1 is $70, right? Now, let's imagine we also look at another firm, an alternative stock, that has a similar regular cash flow 70, but on top of that makes an investment of $500 in year 1, which then would yield an additional cash flow of $150 over 5 years' time. Now, if we were to simply focus on total cash flow as a performance, and we were to decide on which of these two stocks to invest or to lend money to, we might be kind of led to believe that total cash flow will be negative for firm B, whereas it's positive for firm A, and we would lend money or invest in firm A, whereas in contrast, we do know that firm B is actually engaging in a profitable investment. And the overall idea of accrual accounting is to make it right. And so what if we remap that outflow of $500 of investment? Instead of believing that this happens actually all together in year 1, let's smooth it over the horizon, over the useful life. This will lead us to have a much better performance measure, which we call net income, right? Earnings, that will now be more reflective of reality and basically will lead us to understand that firm B has way much better prospects than firm A. So this is simply to get a sense that accrual accounting can be informative, because this accrual depreciation tells us about the value creation of this additional project. And so to think about accrual accounting, think about cash flows that are extremely volatile, and cash flows are inputs to valuation models, but to forecast these cash flows is complex, precisely because they are very volatile. Whereas earnings, through this process of accruals, tend to smooth these cash flows, right? Ultimately, true persistent earnings are earnings that are sustainable, core, recurrent. These true earnings, though, are simply theoretical, because we cannot come up with a true earnings measure over the lifetime of a firm. What managers typically report is reported earnings, right? Which are an approximation. They tend to smooth cash flows, but they don't get to the true perfect earnings. That's for analysts or for investors through fundamental analysis to uncover. What we know that, of course, the standard deviation, so the volatility of cash flow, is much higher than reported earnings, but of course it's still positive, because managers don't know everything about the future. Clearly, they don't have full hindsight. And also they might systematically manipulate earnings for incentives that they might have. And it's for the fundamental analysts, the fundamental investors to uncover through a proper earnings quality analysis what these true earnings might be. Of course, the true earnings that we would want to try to get at are earnings that are persistent, right? And how do we get to earnings that are persistent? We will get to earnings that are persistent through a proper earnings quality analysis, which will help us to isolate the core component of these earnings. So how do we judge the quality of this accrual estimation process? We would say that accruals are of high quality if the manager reports truthfully, right, and uses this discretion to inform capital markets. But sometimes this accrual estimation process could be of very poor quality if instead the manager simply doesn't know what's going to happen in the future, what are the implications of transactions, or for example, if the managers purposely skews the numbers, manipulates the numbers for their own self-interest. And so what earnings quality analysis tries to do is to isolate earnings that are sustainable, earnings that are free of error and manipulation, are informative, and lead us to come up to a measure that is accurate in terms of the underlying economic fundamentals of the business. And so in this course, you will learn how to undo these distortions and to recast earnings and other accounting numbers to come up with better inputs for your valuation models. Factors that influence earnings quality are several. There might be rigidity in accounting rules. Think about the US GAAP that doesn't allow the capitalization of research and development costs, even though this might create value and are indeed assets for the firm. Random forecast errors because managers cannot predict the future, or systematic biases that are impounded into accounting numbers for opportunistic reasons. And now I will hand over to Maria, who's going to discuss more earnings management and how to detect earnings manipulation within financial statements. Thank you.
Thank you, Stefano, and good morning, everyone. So to follow up on Stefano's last point, through their reporting choices, we know that managers may intentionally introduce biases in their financial reports, and this is called earnings management. This could be done with the purpose of misleading stakeholders or with the purpose of achieving certain contractual outcomes, for example. Of course, earnings management is ex ante and observable, and so it's really hard to detect. That said, there are huge stakes here for valuation, and this is because earnings management is going to have a direct effect on fundamentals that we may want to use when valuing a firm by applying, for example, valuation multiples, or to forecast future cash flows, or to kind of come up with an estimate of risk and cost of capital. And so being able to detect instances in which firms might be managing earnings and being able to compute the extent to which earnings are managed is going to be crucial in any valuation exercise. So in this course, in this program, we will spend some time trying to do this, and we'll do this by using templates, Excel templates that we have developed, and applying these templates to real firms and real financial statements. These are templates that are based on state-of-the-art models that have been validated extensively using actual incidences of earnings management and misreporting. Now, these models essentially are based on the intuition that to detect earnings management, one needs to have a good understanding of means, motive, and opportunity. So why do managers manipulate earnings? What changes do managers make in order to manipulate reported earnings? And when are managers more likely to be able to get away with earnings manipulations? Now, managers typically are considered to have two main types of incentives to manipulate accounting numbers, which these models are going to try to take into account. On the one hand, there could be contracting incentives. So for example, managers could be trying to reach certain covenant thresholds to avoid covenant violations and debt contract renegotiation fees and increases in cost of debt. They could be trying to avoid taxation, and this is more likely the case in countries where there is a strong alignment between tax rules and accounting rules. They could be trying to maximize their bonus or to avoid reaching certain regulatory thresholds where they would be exposed to higher regulation, or maybe even to facilitate renegotiations with their employee unions. There could also be market incentives that play a role here. So for example, the desire to meet or beat certain forecasts, analyst targets, to avoid reporting small losses, or to avoid reporting declines in earnings. Managers could be planning to exercise stock options, and so they could be trying to push stock price up, or they could be planning to go public via an IPO or to issue equity or debt. There could also be incentives related not to capital markets, but to the product markets. For example, trying to keep market power and discouraging entry of potential competitors. So all of these incentives could play a role here. And so if we want to understand whether or not earnings are being managed or come up with an estimate of the likelihood of earnings manipulation, then we want to take these incentives into account. The second thing that these models try to do is to think about the means through which managers could achieve these outcomes. So for example, they could be accelerating revenues and deferring expenses. They could be inappropriately capitalizing expenses, which has a very direct implication, for example, for EBITDA, which is often used in valuation. They could be trying to smooth income through cookie jar reserves. They could be taking a big bath because perhaps this year is bad and this year's performance can be blamed on other factors. And this could potentially lead to reserves that could be released in the future to meet certain thresholds. They could also make certain accounting choices strategically in order to achieve certain reporting outcomes. And sometimes this doesn't have to do with the bottom line only or with reporting a certain net income number, but rather with how certain expenses and revenues are shown in the income statement. So trying to push good news above the line and bad news below the line. So these models based on all of these build certain red flags and incorporate those red flags into the prediction. So for example, this could be unexplained changes in accounting methods, changes in assumptions that you make when accounting for long-term assets, or assumptions that you make when estimating your pension benefit obligation within defined benefit plans. You could have receivables or inventory that are growing faster than sales. You could have much lower reserves than peer firms, or or when you look at past credit losses, it could be that your bad debt reserves look relatively small. You could have unexpected write-offs of receivables and loans, of inventories and other types of assets. Typically, what you could see is an increasing gap between earnings and operating cash flow. So changes in the mappings between earnings and cash flows also through time. You could also see an increasing gap between earnings and taxable income. Again, this gap is going to capture all these accrual measures where managers have more discretion. Of course, you could also have other types of red flags that are perhaps more clear, things like audit qualifications or changes in auditors that might have been driven by disagreement. And then the final thing that these models typically look at is opportunity. So you would expect to see higher levels of earnings management in firms where there is higher opportunity to do so without getting caught. So weaker monitoring, for example, by auditors, by the board, by employees, for example, because there are no whistleblowing provisions in place, by regulators, by other external parties like analysts, credit rating agencies, or the media. Also, you would expect to see more management where there is larger discretion in accounting standards. So just to give you a very brief intuition of what these models try to do, you could think about reporting earnings as encompassing two different things. On the one hand, and managed through earnings, and on the other hand, the managed component. So let's suppose that we have a firm and managed earnings are expected to be 100,000. And this number includes a depreciation charge of 35,000, which has been calculated in good faith based on the depreciation rate of 7% that reflects the consumption of the economic benefits that are embodied in these assets. Now, let's suppose that this manager will get a bonus if the firm reports earnings of 120. Then there is an incentive here to report that level of earnings. So how does the manager get there? Well, the manager could potentially get there by reducing depreciation rates from 7 to 3%, decreasing depreciation expense to 15%, to 15,000. So this would basically mean that these reported earnings of 120,000 would be encompassed by unmanaged earnings or true earnings of 100,000 plus a managed component of 20,000, where that managed component is essentially the difference between the true depreciation expense and the managed depreciation expense. So essentially what these models try to do is first try to assess the likelihood that this kind of behavior could be going on, and then trying to assess what is the magnitude of those managed earnings, which is 20,000 in this case. Now, there are different ways that these models try to get at this behavior. If we look at the distribution of earnings, prior academic literature has documented a significant discontinuity around certain thresholds. One of these thresholds are analyst forecasts. There's also a discontinuity around other thresholds, such as earnings equals to 0 or no change in earnings. Basically, what this means, and this plot is done around a threshold of 0 earnings. And what we see is a very small mass of firms that report small losses, very large number of firms that report very small profits. And this basically suggests that firms tend to manage earnings often within the discretion that is afforded within accounting standards to meet that threshold. So if you see a small profit, or if you see a small positive change in earnings, or firms that just meet or beat an analyst forecast by 1 cent, then this could be an indicator of earnings management. Now, in the course, we will discuss other methods that use statistical techniques and that rely on predictive analytics to try to estimate the likelihood that financial statements are managed and to try to account for the portion of earnings that might be managed. So we'll talk about discretionary accruals estimation. We'll talk about the Benisham score, the F score. We'll talk about some interesting new techniques that are based on Benford's law and that look at the prevalence of each digit, of different digits within financial reports. And we will also talk new up-and-coming machine learning techniques. I just want to wrap up my presentation by talking briefly about accounting adjustments, which is something else that we will be discussing in the course. So in price multiple valuation, equity valuation is estimated often by applying a multiple to an earnings construct. Then the question is, how do we define this earnings construct? And in thinking about this, we want to get at a number that is sustainable, that is persistent, that has high predictive power for future cash flows, but at the same time that is as complete as possible. And we will often face this trade-off between persistence and completeness. Now, firms will often do this exercise and they will present non-GAAP earnings that often exclude non-cash or transitory items. And what they're often trying to do is to get closer to these recurring and core earnings that we care about when valuing the business. But there's a lot of evidence that these non-GAAP earnings are often used for impression management. So it's important to be extremely careful about those adjustments. And we will have discussions about adjustments that could make or not make sense. So I'll just finish with one example, and this is Ulta Beauty. During the pandemic, they experienced a decline in their performance. As stores were making fewer and fewer sales, they recorded significant impairments. At the same time, they also received significant federal tax credits from the government. So essentially, there were two COVID-related items that kind of affected their bottom line. On the one hand, they had a 40 million impairment charge for the value of some stores that reduced their operating income. At the same time, they had this 51 million in federal tax credits, and this, of course, has the effect of increasing their net income. Now, when preparing their non-GAAP earnings, they made adjustments for these one-off items. But what they essentially did is they added back the impairment, which potentially could make sense to the extent that this is not a recurring number. They did not subtract, though, these federal tax credits, right? So they ended up reporting $98 million in adjusted operating income, which compared to their $13 million in net income. So these adjustments can be used potentially for impression management. And so it's important that we understand the adjustments that firms are making, whether they make sense, and whether or not we want to make further adjustments before then using these numbers as inputs to our valuation models. So I'm going to wrap up my presentation and to open the floor for Q&A.
So I can see some questions popping up in the chat. James, should I start answering them?
Yes, go ahead, Stefano.
Yeah, thank you. So there is a question that pertains private companies, and so basically how we go about evaluation of private firms and the importance of earnings quality analysis for private firms. And that's a very, very important and interesting question, because in the setting of private equity, actually valuation, fundamental analysis is even more important for valuation, precisely because private firms, in contrast to publicly listed firms, operate in a much more intransparent environment because they are not subject to the level of scrutiny that public firms are subject to. Think about, for example, the fact that in some countries, private firms below a certain size threshold are not audited. And because they are not audited, clearly we cannot in principle trust as much their reported numbers, or we shouldn't blindly put faith on these numbers. And so conducting a proper earnings quality analysis will certainly be even more valuable. And so my answer to that is that fundamental analysis in the context of private equity investments can be really an asset, because by uncovering potential distortions and biases that can not necessarily be due to earnings manipulation, but simply by the fact that the management of the firm cannot perfectly see through certain reported transactions and events that ultimately will lead to publishing results that are not necessarily going to be great input values to valuation models. Because one of the key messages that we would like to reiterate is that it doesn't really matter how complex sometimes valuation models are. You can think about all these fancy models with 2 or 3 stage growth. It doesn't matter how complex the model is. If the quality of the inputs is low, so will be the quality of the valuation output. Sometimes in econometrics and statistics, this concept is referred to as garbage in, garbage out. So as the quality of the inputs is low, so will the quality of the valuation outputs. If okay, I can see also another question, which is somewhat related. So Maria, I might as well answer this one. It's related because it's in between private firms and public firms. The concept of valuing an IPO and the extent to which we should be mindful of potential earnings manipulations in the context of IPOs. Well, there is an extensive literature, academic literature in finance and in accounting that shows that sometimes firms that are preparing for an IPO have incentives to manipulate. And the incentives is really clear, right? If a firm knows that, with the 3 years in advance that an IPO is likely and that the valuation will be based somehow on a parameter that is indexed to current earnings, well, then it's clear that there is an incentive for the management of the firm, or there could be an incentive to overstate earnings to boost up the initial valuation, right? Of course, knowing that in advance is important, and there are techniques that a course like this, an executive education program like this, will allow you to learn in order to basically de-bias financial information from this potential distortions that earnings manipulation may entail. I also want to say that there are also different other sort of incentives that are not necessarily market incentives that can drive earnings management. Maria was alluding to earnings management in the context of meeting or beating analyst expectations. We know that ultimately earnings game, so reporting earnings, is a quarterly game because managers report earnings on a quarterly basis, and so they feel the pressure to meet or possibly beat analyst expectations, and that could give rise to earnings management that then us as fundamental analysts, we need to really carefully think about when making our valuation. But there are also other sorts of situations in which earnings management incentives might arise that are not necessarily related to the market, but actually to contractual arrangements. Think, for example, about compensation. So a fundamental analyst goes beyond accounting numbers and thinks about corporate governance implications for accounting numbers. So it's a very different proposition whether a CEO is paid with a compensation package that is heavy on stock options and stocks, vis-a-vis the case in which a CEO is paid purely, or let's say, for the majority of the compensation component with, let's say, a cash component. Why? Or salary. Why is that important? Because, of course, if you tie the compensation of the CEO to the value of the firm, the incentive of the CEO would be to boost up profitability as much as possible in order for the stock price to go up, and eventually this would affect also the value of the stock options in their compensation packages. And so the fundamental analyst needs to take that into account as an eventuality when looking at earnings number, right? So these are potential red flags that one would have to take into account.
If I may add something, because we have a question in the chat about IPOs and earnings management surrounding IPOs. There's actually a very interesting study that looks at earnings management surrounding the lockup expiration period, and this idea that and they do find evidence of firms managing earnings upwards to facilitate the exit of these pre-IPO investors. And then they do find certain factors that are associated with that. And they identify that as one of the factors that are associated with and that contribute to long-run IPO underperformance, which is, of course, a phenomenon that has been extensively documented in the finance literature. And then perhaps I could tackle another question that talks specifically about the use of AI and the use of machine learning in assessing earnings quality. And yes, there has been a lot done in that area recently that we certainly will discuss in the course. And of course, the advantage here is that with these new data analysis techniques, you can use not only financial information, but also large volumes of non-financial information that are now broadly available in order to kind of forecast this behavior. And we will build heavily on these models that have been very carefully developed and extensively tested out of sample. And they have been shown to have extensive out of sample predictive power for fraud.
Yeah, there are also there are many questions. So some of them are related to the issue of AI and how could we leverage the power of AI and in general machine learning to improve fundamental analysis. I mean, in some hedge funds, Maria and I consult with, sometimes some strategies leverage precisely that, like large sources of data. I mean, to give you a very basic example, there is now this concept of text as data. So think about accounting numbers as just one component of financial statement information. But of course, there is also disclosures, right? MD&A, where basically you can capture through computational linguistics techniques the tone of the disclosure. Is it more optimistic? Is it more pessimistic? Sometimes you can detect whether it's more future-oriented or about discussion of the past, and whether this correlates in the cross-section and in the time series with the prediction of future stock returns. And you'd be surprised that many trading strategies can be developed based on these signals. So this is fundamental analysis 2.0, if you like.
Stefano and Maria, I'm just going to jump in now because unfortunately we're nearing the end of our time. I just wanted to ask one final question, if I may, related to the program itself. How practical is the program, and do you provide things like templates for evaluation models as part of the course?
Maria, do you want to? Sure. We certainly will provide templates, and the focus will really be on, having active discussions among the group and kind of sitting down, looking at real firm financial statements, and with the help of these templates, trying to kind of value these firms. And as we said, some of these templates will be used to kind of assess the quality of the firm's earnings, but we will also be providing templates more broadly to kind of forecast financial statements, doing a scenario analysis, and coming up with those intervals that Stefano was discussing in his presentation for intrinsic value.
Wonderful, thank you. Well, I just want to say a big thank you to you both for sharing your insights in today's session. And also thank you to everyone that submitted a question and been a part of it today. I'm sorry we haven't been able to get through all of the questions, but it's been a really interesting discussion. This is, of course, just a taster. And if you do want to learn more about this topic, please do check out the new executive education program, Financial Statement Analysis and Equity Valuation, which is running from the 19th to the 23rd of February next year. And that's going to be happening in our central London campus. We'll be sending info about that program along with a recording of today's webinar for everyone in the next day or so, so please do look out for that. And yeah, once again, I just want to say a big thank you to everyone who's attended, and we'll be in touch to let you know about future webinars that Executive Education at LSE will be hosting. Enjoy the rest of your day. Goodbye. Thank you.